Hey guys, it's Shiv Haria here from Lifestyle Property People. I wanted to share an important message with you today as the market's starting to change and starting to get a little bit more volatile, a bit more risky, and I'm sure people are thinking about what they need to do. I wanted to share with you a little bit of information about returns in property. So I think we've done videos on this before, so I'm sure most people know who are watching this that there are two types of returns in property. You get rental return and you also get capital growth. Rental return being the return that you make on a monthly or annual basis really on the rent that you're collecting, and then capital growth being the uplift in the value of the property over time, usually over say a 10 or 20 year period rather than on an annual basis, and then divided by the number of years to give you your annual numbers. So we've got rental return and capital growth, and those are basically, people call it double returns. It's two types of returns, and that's why people like properties, because perhaps when you get less rental return you get more capital growth, and when you get less capital growth you get more rental return. I won't go into the mechanics of it right now, but you can just trust me on that for the time being. I'll do another video on it soon. So we have rental return and capital growth, but how much do these account for each other in terms of, like, you know, is it more important to buy a property, or is it more important to try and time the market, or what's the best strategy? Well, one thing that I've learned over the last sort of decade or so of buying properties is that the rental return, when I first started buying properties, rental return was the only thing that I was looking for. I was looking for a great rental return, and I wasn't really paying any attention at all to the capital growth, because really I was like, we don't really know whether capital growth is going to happen. Now that it's been much more sort of documented that capital growth, especially in the regions, so Leeds and Sheffield is the areas that we're investing in, but certainly, you know, the northwest, the northeast, in other areas like that, the capital growth is going to happen because the government have a plan to increase their infrastructure spending in these areas. The capital growth is something that we should be taking into account. Certainly as interest rates starts to increase, the mortgage interest rates start to increase, rental returns start to decrease, and so we're no longer perhaps hitting our minimum rental returns for a lot of the deals that we're looking at. And so what we do need to start doing is taking into account the capital growth element of it. Otherwise we just wouldn't buy any properties, and that's not going to be good for anyone. So in terms of taking into account the capital growth, it is obviously a bit of a guessing game because we don't know what the capital growth is going to be. But what we can do is do two things. One, look at the last 20-year period. What has the capital growth been as an average over the last 20 years per annum? And also, second thing we can do is say, well, let's extrapolate that over the next 20 years and think about what that's going to be for the next 20 years. Now, it might be the same, might be less, or it might even be more. I just mentioned that the government have a plan to increase their infrastructure spending in these in the regions to bring them kind of more in line with the London market at the moment. And as a result, there is going to be an increase in capital growth in these areas. Currently, capital growth is on average in the UK somewhere in the region of 9 to 11%. In Leeds and Sheffield at the moment, the capital growth is probably in the types of properties that we're buying, probably well over 10%, because we buy in specific areas that get the capital growth. And whilst we buy in those areas, but we know we're going to get, you know, perhaps at the moment over 10% capital growth, we don't actually sell our deals based on any capital growth. We just say this is the rental return that you're getting. But it is useful to take into account the capital growth, and this is the reason why. So 4 minutes of my video so far has been building up to this nugget of gold for you. The rental return on a property accounts for one third, 33% of the overall return being the rental plus the capital growth. So the rental return accounts for 1/3 of the overall return over a 20-year period. So for a 20-year period, that means that the capital growth, the growth in the value of the property, is going to account for 2/3 of the return. So what does that mean? So let's just say, for the sake of argument, that on average, a property that we might buy at the moment might make between £3,000 and £5,000 a month on rental cash flow. Cash flow being the, let's call it the net rent, after all the costs have gone out before tax. Let's say that number, I say 3 to 5, let's just say 5 to make the maths easy. If it's £5,000 on rental cash flow per annum, What we're saying is, on average, you should be getting £10,000, so 5 times 2, £10,000 on capital growth per annum, at least. So making £5,000 on rental return, £10,000 on capital growth per annum as an average over the next 20 years. And that means that as interest rates increase, if that as base rates increase, the mortgage interest rate increases. Because your mortgage interest rate increases, the cash flow or the rental profit, the net rent, decreases because your costs increase, your costs of borrowing the money increase. So the actual profit that you have at the end of the year decrease. But if the profits decrease, that means your rental return, the percentage, also decreases. So when we're saying it's £5,000, it might now be £4,500 rather than £5,000. It might even be £4,000 depending on how much the rates increase. And that's really bad. And it means that now, instead of making, I don't know, an 8% return, you might make a 6% return, or a 6% return, you might make a 4% return, which is no good. However, you keep in mind that over the next 20 years, the capital growth is a thing that is going to make 2/3 of the return. Then actually over the next 20 years, that £500 reduction in net rent, in profit per annum, adds up to 5 times by 20 is £10,000. £500, £5,000 times by 2 is £10,000. So you'll have lost £10,000 because the interest rate has increased, but you'll have gained £10,000 for every year that you've held the property, because that's the capital growth. It's twice as much as the rental cash flow, as the rental profit. Does that make sense? So what we're saying is that even though the mortgage interest rates are increasing, even though your rental returns are decreasing, the capital growth is still there. It's still planned in for the next 20 years, and therefore it's still well worth your while continuing to invest. I mean, worst case scenario right now, you keep your money in the bank account and it reduces in real value because inflation's running at 9, 10, 11, 12%. So yeah, it's a challenging time at the moment out there in the markets. There's lots of conflicting information, but certainly the worst thing you could do right now is to do nothing. If you just keep your money in the bank because you hope that, you know, it's safest in the bank, that's the worst thing you could do. If you put it in other markets, so cryptocurrency, stock markets, etc., we know that those are volatile markets. In property, because you get the double return, you get the rental and the capital, it may work out much better for you as long as you keep it in there for the long term, over a 10 or 20 year period. So I hope that helps. Little conversation there about rental return and capital growth, and hope that nugget is useful for you. Take care. Bye bye.